There is a ghost that haunts the stock market. It's a phantom that whispers a seductive and deeply intuitive lie into the ear of nearly every investor, from the novice opening their first brokerage account to the seasoned professional managing millions. The lie is this: bigger is safer, heavier is stronger. A company with colossal factories, gleaming fleets of trucks, and vast tracts of land is a fortress of stability. We see the tangible, the physical, the monumental, and our ancient primate brains equate it with permanence, with power, with a safe place to put our capital. We drive past a sprawling manufacturing plant, smokestacks churning out plumes of white vapor against a gray sky, and we think, now that is a real business. That is something solid. And in that single, flawed assumption, fortunes are lost. Decades of potential wealth creation evaporate into the very air those smokestacks pollute. Because Warren Buffett, the man who built a $600 billion empire from the ashes of a failed textile mill, discovered a secret early in his career. He learned that the greatest businesses on earth, the true engines of unimaginable wealth, are often the ones you can't see. They are ghosts in the machine. They are businesses built not on steel and concrete, but on an idea, a brand, a network, a habit in the mind of the customer. And he found a way to measure the power of these invisible fortresses with a single, elegant number. This number cuts through the noise of financial reporting, it ignores the siren song of impressive physical assets, and it points like a compass needle directly toward the cash-generating heart of a business. It's a principle so powerful that it transformed him from a brilliant but limited cigar-butt investor into the greatest capital allocator the world has ever known. Today, we are going to dissect that principle. We will not just learn what it is, but why it works on a deep psychological level. We will learn how to calculate it, how to apply it, and how to use it to avoid the most common and costly mistake in all of investing: the capital-intensive trap. This is not just a lesson in stock analysis. This is a fundamental shift in how you view the entire landscape of business and wealth. This is the key to differentiating a good business from a truly great one. This is the financial transformation that allows you to stop betting on companies that own a lot of stuff and start investing in companies that own a mind. This is the hunt for the asset-light compounding machine. Our journey begins not in the hallowed halls of Wall Street, but in the sun-drenched avenues of California in the early 1970s. It's a story about chocolate, and it is the foundational moment where Warren Buffett's entire investment philosophy pivoted on a dime. This is the story of See's Candies, and it is the single most important acquisition he ever made, not because of its size, but because of the profound lesson it taught him and his partner, Charlie Munger. By 1972, Buffett had already made a name for himself. He was a master of the Benjamin Graham School of Value Investing. His method was deceptively simple. Find a business trading for less than the value of its assets if you were to liquidate it. He called it cigar butt investing. You'd walk down the street, find a discarded cigar butt with one good puff left in it, pick it up, take that puff for free, and toss it away. It was about buying fair companies at wonderful prices. He was buying net-nets, companies whose current assets minus all liabilities were worth more than the company's total stock market price. These were often ugly, struggling businesses in dying industries: a textile mill, a department store, a farm equipment manufacturer. The appeal was purely mathematical, a statistical safety net. But Charlie Munger, his brilliant and curmudgeonly partner, was planting a seed of a different idea in his mind. Munger argued that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The problem was, what made a company wonderful? The answer arrived in the form of a family-owned chocolate company. See's Candies was a California institution, founded in 1921 by Mary See. It had a fanatically loyal customer base. People didn't just buy See's chocolates. They felt a deep emotional connection to the brand, to the black and white checkered stores, to the free samples. It was a part of family traditions, of holidays, of life itself. The family decided to sell, and a man named Robert Flaherty at Blue Chip Stamps, a company Buffett controlled, brought the deal to Warren and Charlie. The asking price was $30 million. Buffett took one look at the books and initially balked. The company had about $8 million in tangible assets, things like the candy-making equipment, the stores, the inventory. It was earning about $2 million a year after taxes. $30 million was nearly 4 times the value of the physical stuff. This violated every rule of Graham-style investing he had ever known. His entire training screamed that this was a terrible deal. You could never liquidate See's for $30 million. It was, on paper, a huge overpayment for the underlying assets. This is where Charlie Munger stepped in and, in his own words, shoved him into it. Munger saw something Buffett was still training his eye to see. He saw the invisible asset. The true value of See's candies wasn't in the copper kettles or the delivery trucks. It was in the minds of millions of Californians. It was the brand. This brand gave See's a magical power, pricing power. Because customers were so loyal and so emotionally invested, See's could raise the price of its chocolates every year, year after year, without any fear of losing its customers to a cheaper competitor. Nobody bought See's because it was the cheapest chocolate. They bought it because it was See's. This pricing power, combined with another crucial factor, made the business an economic marvel. The business required almost no new capital to grow. Think about it. To sell more chocolate, they didn't need to invent a revolutionary new candy-making technology. They didn't need to build a billion-dollar factory. They just needed to make more of what they were already making, maybe open a few more stores. The annual capital expenditures were minuscule. So what happened to all the cash the business generated? It just piled up. It was a gusher of cash that didn't need to be reinvested back into the business just to keep the lights on. Buffett, finally convinced by Munger, negotiated the price down to $25 million and closed the deal. It was the most he had ever paid for a business relative to its tangible assets. And it changed everything. That initial $2 million annual profit grew and grew. See's became Berkshire Hathaway's cash cow. Over the decades, that little chocolate company, purchased for $25 million, would go on to generate over $2 billion in pre-tax earnings for Berkshire, almost all of which could be sent back to Omaha for Buffett to invest in other businesses. It was the engine that funded his purchases of Coca-Cola, the Washington Post, and countless other wonderful businesses. See's Candies was the proof. It was the living embodiment of an asset-light business model. It demonstrated that the return a business earns on the tangible capital it employs is one of the most important determinants of its long-term value. See's was earning $2 million on $8 million of tangible assets, a 25% return. And that was the secret. It wasn't the size of the factory that mattered, it was the profitability of the factory. And in the case of See's, the real factory was the brand, an intangible asset that required no maintenance, no depreciation, and no upgrades, yet produced ever-increasing streams of cash. This was the revelation that set the stage for the entire Warren Buffett strategy as we know it today, a strategy focused on wealth creation not through statistical bargains, but through owning economic fortresses. The See's Candies story is so powerful because it reveals a deep-seated psychological flaw that affects almost every investor. To understand the genius of Buffett's shift, we must first understand the cognitive biases he was overcoming in himself, and that the average retail investor still succumbs to every single day. The first and most powerful is what psychologists call the tangible asset bias. Our brains are wired over millennia of evolution to value what we can see, touch, and measure. A farmer with 1,000 acres of land, a large barn, and a fleet of tractors is perceived as wealthier and more secure than a poet with a brilliant mind, even if the poet's works will generate royalties for centuries. The tangible feels real, the intangible feels ephemeral. In the world of investing, this bias manifests as a deep-seated attraction to companies with significant physical footprints. We see a company like an automaker, with enormous factories covering square miles, employing tens of thousands of people, with a global logistics network of ships and trucks, and we are impressed. It feels permanent. It feels safe. We subconsciously believe that all that stuff on the balance sheet provides a hard floor for the stock's value. We think, even if the business struggles, they can always sell the factories and the equipment. This is a comforting but profoundly dangerous illusion. Buffett's early career was built on a more sophisticated version of this bias. Benjamin Graham's method was essentially a bet on tangible assets, buying companies for less than their liquidation value. It was a rational, numbers-based approach, but it was still fundamentally anchored to the idea that value resides in the physical. Munger's great contribution was forcing Buffett to see that the most valuable asset a company can have is one that doesn't appear on the balance sheet at all. A durable competitive advantage, often in the form of a brand, a patent, or a network effect. This leads to the second major psychological hurdle, anchoring bias. This is our tendency to rely too heavily on the first piece of information offered when making decisions. For Buffett in 1972, his anchor was book value. He was anchored to the idea that paying a significant premium over the stated value of a company's tangible assets was speculative and risky. The asking price of $30 million for See's felt outrageously high because his mental anchor was the $8 million in tangible assets. He had to be mentally dragged, kicking and screaming, away from that anchor to see the true earning power of the business. The average investor does this all the time. They anchor on the stock price itself, or on a simple metric like the price-to-earnings ratio, without digging deeper. They see a company with a low P/E ratio and think it's cheap, without asking why it's cheap. Often, it's cheap because the market correctly understands that the business must spend enormous sums of capital just to maintain its current level of earnings, leaving little free cash for shareholders. The company is running on a capital-intensive treadmill, and its low P/E ratio is a reflection of its poor underlying economics, not a bargain opportunity. Overcoming this requires a conscious effort to re-anchor your analysis on a more meaningful metric, like the return on tangible assets, which measures the fundamental quality of the business rather than just its current market price. This is the essence of moving from a speculator to an investor, from a stock picker to a business analyst. It's about shifting your entire frame of reference from what the market is saying about the price to what the financial statements are saying about the business's ability to generate cash. The See's Candies purchase was Buffett's personal and professional re-anchoring. It taught him that a company capable of generating a 25% or 50% or even 100% return on the net tangible assets required to run the business is a far superior investment, even at a higher initial price, than a company that earns 6% on a giant pile of mediocre assets. So how do we as individual investors take this profound psychological insight and turn it into a practical, repeatable process? We need to translate the theory into an applied mental model, a blueprint that we can use to analyze any business. Let's call it the brand power litmus test, a way to identify the kind of intangible moat that made See's Candies so valuable. This isn't just stock analysis. This is becoming a detective of business quality. The first step in this model is to ask a simple, qualitative question that cuts to the heart of a company's competitive position. If you were the CEO of this company, could you raise prices by 10% tomorrow morning without losing a significant number of your customers to a competitor? Think about that for a moment. Could your local gas station do that? No, you'd drive across the street to save 3 cents a gallon. Could a generic steel manufacturer do that? No, steel is a commodity, and their customers would immediately switch to a cheaper supplier. Now think about Apple. If they raised the price of the next iPhone by 10%, would their sales collapse? Absolutely not. Some people would grumble, but the vast majority of loyal customers would pay it. Think about your Starbucks coffee. If the price went up by 30 cents, would you stop going? Probably not. That is the signature of a powerful brand and a deep competitive moat. It's the ability to command a price premium without a corresponding loss of business. This simple thought experiment is your first and most powerful filter for identifying asset-light business models with strong intangible value. The second step in our blueprint is to look for quantitative evidence of this pricing power in the company's financial statements. A truly great brand often doesn't need to shout. You want to analyze the company's advertising or marketing budget, often labeled as selling, general, and administrative. or SG&A expenses, as a percentage of its total revenue. Do this over a 10-year period. What you're looking for is a brand so powerful that it pulls customers in, rather than the company having to constantly push its message out. For many powerful brands, you'll see that their advertising spend as a percentage of revenue is stable, or even declining, while their revenue continues to grow. The brand itself is doing the heavy lifting. Contrast this with a company in a fiercely competitive industry, like consumer packaged goods. You'll often see them spending enormous and ever-increasing sums on marketing just to maintain their market share. They are in a constant, expensive battle for consumer attention. This is a sign of a weak moat and poor economics. A strong brand is an asset that works for you. A weak brand is an expense you have to constantly pay. The third and final step of the brand power litmus test is to examine the company's gross margins over at least a decade. The gross margin is calculated by taking a company's revenue and subtracting the direct costs of producing the goods or services it sells, cost of goods sold or COGS. A consistently high and stable gross margin is the financial fingerprint of pricing power. It shows that the company can charge a price for its product that is significantly higher than its direct costs. See's Candies could sell a pound of chocolate for many multiples of what the sugar, cocoa, and labor cost. A commodity business like an airline or a steel mill has razor-thin gross margins because they have no pricing power. They are price takers, not price makers. When you find a company that passes all three of these tests, it can raise prices, it doesn't need to spend a fortune on marketing to grow, and it has consistently high gross margins, you have likely found a business with a powerful intangible asset at its core. You have found a potential See's Candies. This is the first practical step in your financial transformation, moving you away from the allure of tangible assets and towards the quiet, compounding power of an invisible fortress. This mental model is your entry point into the advanced Warren Buffett strategy, a tool to begin your journey toward true financial freedom by focusing on business quality above all else. To truly appreciate the wisdom of investing in asset-light wonders, we must spend time exploring the opposite path, the path of the 99%. This is the road littered with the wrecks of failed investments, the path paved with the good intentions of investors who fell for the tangible asset trap. This is the antithesis of the Buffett-Munger approach, and it's embodied by the cigar butt investor who never evolved. The perfect example of this flawed approach is the very company that gave Berkshire Hathaway its name, the original textile mill. When Warren Buffett first took control of Berkshire Hathaway in the 1960s, it was a struggling New England textile manufacturer. It fit the classic Ben Graham model. The company was trading for a ridiculously low price, far below what its looms, buildings, and inventory were worth. It was a statistical bargain, a cigar butt lying on the ground. Buffett bought it, thinking he could wring out that last free puff of value. But what he quickly discovered was that he had bought into a terrible business in a dying industry. The textile business was the definition of capital-intensive. It required enormous, expensive, specialized machinery. And the worst part? That machinery was constantly becoming obsolete. Every year, a competitor would develop a slightly faster, slightly more efficient loom. To stay even remotely competitive, Buffett had to constantly reinvest any meager profits the business generated right back into buying new equipment. It was a capital expenditure treadmill running at full speed. He was pouring money into the business just to stand still. The looms were tangible, they were real, you could touch them. But they were terrible assets. They earned a horrifically low return on the capital invested in them. Worse still, the product they produced, textiles, was a pure commodity. He couldn't go to his customers and say, "I'm raising the price of my woven cloth by 10% because it's Berkshire Hathaway cloth." His customers would have laughed and immediately bought from a cheaper competitor in the South or, increasingly, overseas. He had zero pricing power. This combination of high capital requirements and no pricing power is the lethal cocktail that destroys shareholder value. Buffett himself later described owning the textile mill as carrying a 200-pound man up a mountain. Every step was a struggle. For years, he poured the profits from his other, better investments into this black hole, trying to keep it alive. It was an enormously costly lesson in the difference between a cheap asset and a good business. The 99% of investors make this mistake constantly. They see a company in a heavy industry, like manufacturing, mining, or transportation, and they see a stock price that has fallen significantly. They look at the balance sheet, see billions of dollars in property, plant, and equipment, and think they've found a bargain, a margin of safety in the hard assets. They are buying today's Berkshire Hathaway textile mill. They fail to ask the crucial question: what is the return that those assets are generating? And how much new capital will be required next year just to maintain the current, likely pathetic level of profitability? This is the path of the herd, the path of mistaking size for strength, and it almost always leads to disappointing returns and immense opportunity cost. It's the antithesis of a wealth creation strategy. It is a wealth preservation strategy at best and a wealth destruction strategy at worst. The ultimate triumph of Warren Buffett was not just buying the textile mill, but in having the wisdom to eventually shut it down and use its name and its remaining capital as a vehicle to buy wonderful asset-light businesses like See's Candies. He turned the symbol of his greatest mistake into the foundation of his greatest success. Let's quantify this. Let's make the abstract tangible and see how this principle manifests directly on a company's financial statements, creating a massive and quantifiable financial advantage. This is where we bridge the gap between a good story and a concrete investment strategy. The financial magic of a business like See's Candies lies in the relationship between its income statement and its balance sheet. Let's revisit the numbers from the 1972 acquisition. See's had approximately $8 million in net tangible assets. This is the capital required to run the business: the kitchens, the stores, the inventory, minus any liabilities. It was generating about $2 million in after-tax profit. A simple way to look at this is return on tangible assets. $2 million in earnings divided by $8 million in tangible assets gives you a return of 25%. Now compare that to the textile mill. A capital-intensive business like that might have $100 million in tangible assets: the factory, the looms, all the heavy equipment. But because of intense competition and no pricing power, it might only generate $6 million in profit. That's a return of only 6%. On the surface, $6 million in profit sounds better than $2 million. The business is bigger, but the bigger business is a far worse business. Here's why. Let's say both businesses want to grow their earnings by $1 million. For the textile mill, earning 6% on its capital, it would need to invest roughly another $17 million in new factories and equipment to generate that extra $1 million in profit. It needs to keep feeding the beast. Where does that $17 million come from? It has to be retained from its profits, or the company has to take on more debt, or it has to issue more stock, diluting existing shareholders. Now look at See's Candies. To generate an extra $1 million in profit, earning 25% on its capital, it only needs to invest an additional $4 million. The difference is staggering. But the story gets even better. Because of its brand, See's could often grow its profits simply by raising its prices, which required almost zero times additional capital. This is the holy grail of business. This is what creates a true gusher of free cash flow. Free cash flow is the cash a business generates after accounting for all the capital expenditures needed to maintain and grow its operations. In a capital-intensive business like the textile mill, free cash flow is often a tiny fraction of reported net income, or even negative, because all the cash is being plowed back into the machinery. In an asset-light business like See's Candies, free cash flow is often very close to net income. This is the cash that can be used for purposes that directly benefit shareholders. It can be paid out as dividends. It can be used to buy back stock, increasing each shareholder's ownership percentage of the business. Or, in the case of Berkshire Hathaway, it could be sent back to Omaha for Warren Buffett to allocate to even more wonderful businesses. That $25 million purchase of See's, because of its incredible financial characteristics, became a fire hose of cash that funded the acquisition of other asset-light giants, creating a virtuous cycle of compounding. This is the direct financial connection. The high return on tangible assets translates directly into massive free cash flow generation, which is the ultimate source of all long-term shareholder returns and the engine that drives true portfolio growth. Ignoring this metric is like trying to drive a car by only looking at the speedometer while ignoring the fuel gauge. It's the difference between motion and progress, between activity and achievement. The mistake of falling in love with big, heavy, and seemingly secure businesses is one of the most common and devastating traps in the world of investing. To fully inoculate ourselves against this error, we must explore a story of when even the master, Warren Buffett himself, fell victim to it, long after he should have known better. This is the story of Dexter Shoe Company, a deal he has publicly called his single worst investment mistake, not in percentage terms, but in absolute dollars. It serves as a chilling and powerful illustration of the capital-intensive trap. The year was 1993. Buffett had already owned See's Candies for over 2 decades. He had preached the gospel of buying wonderful businesses with durable competitive advantages. He was at the peak of his powers. He was introduced to Dexter Shoe, a shoe manufacturer based in Maine that had a long history of producing quality, American-made footwear. The company seemed to have all the hallmarks of a classic Buffett investment. It had a solid brand, a folksy, family-run history, and a reputation for quality. Buffett was so impressed with the business, with its management, and with its seemingly durable position in the marketplace, that he decided to buy the entire company. But he made a fateful decision. Instead of paying with cash, he paid with Berkshire Hathaway stock, issuing shares worth approximately $433 million at the time. Almost immediately after the ink was dry, the world began to change. The competitive landscape for shoe manufacturing was shifting violently. Low-cost foreign competitors, with access to much cheaper labor, began to flood the market with shoes that were of decent quality but sold for a fraction of the price of Dexter's. Dexter's perceived moat, its brand and Made in America reputation, turned out to be a shallow ditch, not the impenetrable fortress Buffett had imagined. Suddenly, customers who had been loyal for years began to switch to the cheaper alternatives. Dexter's pricing power evaporated overnight. It was a commodity business, and it didn't even know it. This is where the capital-intensive nature of the business turned a bad situation into a catastrophic one. Shoe manufacturing requires factories. It requires specialized cutting and stitching equipment. It requires a large workforce. To compete with the new, low-cost competition, Dexter would have had to engage in a brutal price war, and to do that, it would have needed to invest hundreds of millions of dollars in new, more efficient factories and technology, just to try and lower its production costs to a competitive level. It was the Berkshire textile mill all over again, but on a much larger and more painful scale. The business became a black hole for capital. It was a machine that consumed cash rather than producing it. The competitive advantage was gone, and all that was left was a collection of factories and equipment whose earning power was rapidly declining to zero. The final, brutal irony of the Dexter Shoe disaster was the method of payment. Because Buffett had used Berkshire Hathaway stock, the true cost of the mistake was not the initial $433 million. The true cost was what those Berkshire shares would be worth today. Those shares, had they remained in the hands of Berkshire shareholders, would now be worth billions upon billions of dollars. He had traded a piece of his collection of wonderful, asset-light businesses, like See's Candies and Coca-Cola, for a capital-guzzling, dying enterprise. He traded a piece of the best business in the world for one of the worst. It was a mistake of epic proportions, and it stands as Buffett's most public and painful reminder that no matter how attractive a business may seem on the surface, if its moat is not durable and it operates in a capital-intensive industry, it can become a value trap of the highest order. It underscores the vital importance of the lesson we are dissecting today. The most dangerous investments are often those that require continuous, heavy injections of capital just to survive, because when the competitive winds change, those heavy assets become an anchor that drags the entire enterprise to the bottom of the sea. The psychological pull of the Dexter shoe mistake is rooted in a pair of powerful cognitive biases, the sunk cost fallacy and commitment bias. These mental errors don't just affect investors, they plague corporate executives and entrepreneurs, leading to disastrous capital allocation decisions. The sunk cost fallacy is our tendency to continue with a course of action simply because we have already invested significant time, money, or effort into it, even if new information suggests it's a losing proposition. Think of the executives at Dexter Shoe, or any company in a similar predicament. They have spent decades and hundreds of millions of dollars building their factories. The factories are their identity. When faced with declining returns, the rational decision might be to shut down the least profitable plants and shrink the business. But the sunk cost of those factories makes that decision emotionally and psychologically excruciating. The thought process becomes, we've already invested so much in this plant, we can't just walk away now, we have to spend a little more to try and make it work. This leads to good money being thrown after bad, a cycle of reinvestment into low-return assets that slowly bleeds a company dry. Investors fall for this too. An investor might buy a stock in a heavy manufacturing company. The stock goes down. The company announces a new, expensive plan to upgrade its facilities to become more competitive. The investor, seeing this new investment as a sign of commitment and already emotionally invested in their initial purchase, decides to double down, buying more shares. They are succumbing to the sunk cost fallacy, averaging down on a bad business, rather than admitting their mistake and reallocating their capital to a better one. This is deeply connected to commitment bias, our desire to remain consistent with our past decisions and beliefs. When we buy a stock, we have made a public, even if only to ourselves, commitment to the idea that it is a good investment. When evidence to the contrary emerges, it creates cognitive dissonance. To resolve this discomfort, it's often easier to rationalize our original decision and find reasons to stick with it than it is to admit we were wrong. We see the giant factory not as a liability in a changing world, but as a confirmation of our initial thesis that this is a solid company. We see the CEO's commitment to pour more money into the business not as a desperate gamble, but as a sign of strong leadership. We filter the information to fit our pre-existing commitment. Buffett's genius, and what every retail investor must learn, is the ability to brutally suppress these biases. His decision to eventually shut down the textile mills and to publicly admit the full, staggering scale of the Dexter shoe mistake demonstrates a rare intellectual honesty. It's the ability to look at a business not for what it has been or what you hoped it would be, but for what it is today and what its future prospects for generating cash truly are, independent of the capital that has already been sunk into it. To avoid the Dexter shoe trap, we need a mental model that acts as an early warning system. We need a way to spot these capital-guzzling treadmills before they destroy our portfolio. Let's call this the capital expenditure treadmill test. This is a simple but profoundly effective tool that any investor can use with just a company's financial statements. It's a key part of any serious financial statement analysis. The first step is to open up the company's statement of cash flows. This is arguably the most important of the three financial statements because it shows where the actual cash is going, stripped of the accounting fictions that can obscure reality on the income statement. You are looking for a line item called capital expenditures or purchase of property, plant, and equipment. This number represents the cash the company spent in a given year on buying or upgrading its physical assets. The second step is to compare this capital expenditure (CapEx) number to another line item, usually found right near the top of the same statement: depreciation and amortization. Depreciation is an accounting expense that is meant to represent the gradual wearing out of a company's assets over time. In theory, the amount a company spends on maintenance CapEx, the money required just to keep the current business running as is, should be roughly equal to its depreciation charge. Therefore, if a company's total CapEx is consistently and significantly higher than its depreciation charge, it's a potential red flag. It suggests that the company has to spend enormous sums of money, not just to maintain its business, but also to grow it. Or, even worse, it might be spending more than its depreciation charge just to stand still, because its industry requires constant, expensive upgrades. This is the first sign of the treadmill. The third and most crucial step is to put this in context by calculating CapEx as a percentage of the company's total sales over a 5 to 10-year period. A business that has to consistently spend, say, 15% of its revenue on CapEx is a fundamentally different and less attractive business than one that only has to spend 2%. Look for the trend. Is that percentage growing? If a company's capital expenditures are growing faster than its sales, it's a massive warning sign. It means the business is becoming less efficient at generating revenue from its asset base. It's having to spend more and more just to win the same amount of business. This simple three-step analysis would have screamed a warning about the shoe industry or the textile industry. It would show you the brutal economics of the airline industry, which constantly has to spend billions on new planes. It is the quantitative signature of a capital-intensive business, and it is your best defense against falling for the illusion of tangible asset safety. This test helps you move beyond the income statement and see the true cash reality of a business, a critical skill for anyone serious about beating the market and achieving long-term portfolio growth. The perfect antithesis to the asset-light business model, the ultimate cautionary tale of capital intensity, is the airline industry. For decades, it has been a poster child for value destruction, a place where vast sums of capital go to die. Buffett himself famously quipped, "If a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his descendants a lot of money." Why is the industry so notoriously difficult? It boils down to the two toxic ingredients we've been discussing: extreme capital intensity and a near-total lack of pricing power. First, the capital intensity. An airline's primary asset is an airplane. A modern commercial jetliner can cost anywhere from $100 million to nearly $500 million. And you don't just need one, you need a whole fleet. These are monstrously expensive, depreciating assets. They require constant, costly maintenance. The fuel to operate them is a massive, volatile expense. The industry is a bottomless pit for capital. The balance sheets of major airlines are groaning under the weight of trillions of dollars in property, plant, and equipment, and the colossal debt loads required to finance them. Second, and just as important, is the lack of a durable competitive advantage or pricing power. When you, as a consumer, are booking a flight from New York to Los Angeles, what is your primary decision-making factor? For over 99% of travelers, it's price. You might have a slight preference for one airline over another, but if a competitor is offering a ticket for $100 less, you are almost certain to take it. The service is a commodity. A seat on a Delta flight is, for all intents and purposes, interchangeable with a seat on a United or American flight. This creates a brutal, dog-eat-dog environment of constant price wars. Any attempt by one airline to raise fares is immediately undercut by its competitors. This means that despite the billions of dollars invested in their fleets, they have almost no ability to command a premium price for their service. This lethal combination has led to a history of bankruptcies, bailouts, and abysmal returns for investors. An investor in the 1980s or 1990s looking at the airline industry would have seen all the hallmarks of the tangible asset trap. They would see huge, impressive, tangible assets, the planes. They would see massive revenues. But applying the principles we've discussed, a savvy investor would have seen the truth. A capital expenditure treadmill test would have shown that these companies were spending staggering sums on new aircraft year after year, often far in excess of their depreciation charges. A brand power litmus test would have been a catastrophic failure. No airline could raise prices 10% without a mass exodus of customers. The industry's consistently razor-thin and often negative profit margins would be the final nail in the coffin. It is the perfect illustration of how a business can be enormous, essential to the modern economy, and simultaneously be a terrible investment. It teaches us that the size of the assets and the level of revenue are meaningless metrics if the return on those assets is chronically poor. Let's put some hard numbers on this and deconstruct the financial statements to see exactly how a capital-intensive business destroys value compared to an asset-light one. Imagine two companies, each generating $10 million in pre-tax profit. Company A is Airline Inc., and Company B is Brand Company, a hypothetical software or branding company. Airline Inc. needs $100 million in tangible assets, planes, airport gates, maintenance facilities, to generate its $10 million in profit. Its pre-tax return on tangible assets is 10%. Brand Company, on the other hand, only needs $10 million in tangible assets, some office space, servers, and computers, to generate its $10 million in profit. Its pre-tax return on tangible assets is a staggering 100%. Right away, we see Brand Company is a vastly more efficient and profitable business. Now let's watch what happens when both companies want to grow. Let's say they both want to double their profits to $20 million. To do this, Airline Inc., with its 10% return on assets, needs to go out and acquire another $100 million worth of new planes and equipment. This money has to come from somewhere. It will likely have to take on a huge amount of new debt, which comes with hefty interest payments that will eat into future profits. It might have to issue new stock, diluting the ownership stake of its existing shareholders, and after all that, it has simply replicated its low-return business on a larger scale. Brand Company, needing only $10 million in new tangible assets to generate another $10 million in profit, might be able to fund its entire expansion out of its own cash flow from a single year. It doesn't need to take on debt or dilute its shareholders. But the reality is even more dramatic. A great software or brand-focused company can often grow its profits by far more than that, with almost no times additional capital. Once the software is written, the cost to sell 1 million more copies is near zero. Once the brand is established, it can be leveraged into new products or markets for a fraction of the cost of building a new factory. This difference flows directly to the bottom line and into the pockets of shareholders. Airline Inc.'s income statement is burdened by massive depreciation charges and huge interest expenses. Its cash flow statement shows that nearly all of its operating cash flow is immediately consumed by capital expenditures. There is very little, if any, free cash flow left over for shareholders. Brand Company, by contrast, has minimal depreciation and interest expenses. Its cash flow statement shows a geyser of free cash flow, which it can use to pay dividends, buy back its undervalued stock, or make smart acquisitions. This is the mathematical engine of wealth creation. Over a decade, the stock price of Brand Company is likely to have compounded at an astonishing rate, while the stock price of Airline Inc. will have likely gone sideways or down, punctuated by periods of terrifying volatility. This is not a matter of opinion, it is a matter of financial physics. The gravitational pull of low returns on capital is simply too powerful to overcome, no matter how big the factory or how impressive the airplane. Having established the critical importance of asset-light business models, we must now dive into the technical details. We need to formalize this concept into a powerful, quantifiable tool. This brings us to the core principle itself, the calculation and interpretation of return on tangible assets, or as we'll call it, ROTA. This is the number that acts as our compass, guiding us through the complex world of financial statements toward high-quality businesses. And the perfect story to illustrate its application is not an obvious tech company, but one of Buffett's earliest and most brilliant investments, the Washington Post. In the early 1970s, newspapers were not seen as asset-light businesses, they were seen as industrial operations. They owned giant, expensive printing presses, fleets of delivery trucks, and large downtown buildings. They were heavy, tangible businesses. But Buffett, using a mental framework very similar to a ROTA calculation, saw through this physical facade to the economic reality underneath. He analyzed the Washington Post, run by the brilliant Katharine Graham, and saw that it was not just a newspaper, it was a media franchise with an almost unbreakable monopoly on its local market. In a city like Washington, D.C. at that time, if a department store wanted to advertise a sale, or if someone wanted to sell their car through the classifieds, they had no real alternative to the Washington Post. This dominance gave the Post incredible pricing power. They could raise their advertising rates every year, and their customers had no choice but to pay. Buffett recognized that while the company did own tangible assets like printing presses, the value of those assets was dwarfed by the value of this intangible monopoly. The printing press was just the tool. The real business was the franchise. He did the math. He looked at the profits the business was generating and compared them to the capital that was actually required to run the operation. He saw that the returns were immense. The business generated huge amounts of cash, far more than was needed to upgrade the presses or maintain the delivery fleet. It was a cash gusher, much like See's Candies, but disguised as a heavy industrial company. In 1973, during a bear market, the stock price of the Washington Post Company fell to a point where the entire business was valued by the market at about $80 million. Buffett knew, from his analysis of its earning power and its asset-light reality, that the business was worth at least $400 million, maybe more. He began buying shares aggressively, investing over $10 million, becoming the company's largest outside shareholder. That investment would go on to compound into one of the greatest investments of all time, eventually becoming worth over $1 billion. It was a classic Buffett masterstroke, made possible not by buying a statistical bargain but by understanding the true economics of a business and its ability to generate high returns on the tangible capital it employed. He ignored the physical press and invested in the invisible franchise. The reason a metric like return on tangible assets is so powerful is that it helps us overcome two very common psychological traps that plague the average investor: the availability heuristic and metric fixation. The availability heuristic is a mental shortcut where we rely on immediate examples that come to mind when evaluating a specific topic or decision. In investing, the most available metrics are the ones you see every day on financial news channels or websites: the stock price, the daily percentage change, and the price-to-earnings (PE) ratio. Because these are constantly presented to us, our brains assign them a disproportionate level of importance. We start to think that a low PE ratio is the definition of a cheap stock, without doing the deeper work to understand the quality of the underlying business. This leads directly to metric fixation. This is the tendency to become so focused on a few simple popular metrics that we fail to see the bigger picture. An investor might build their entire stock-picking process around finding companies with PE ratios below 15, for example. They become fixated on this one number. But the PE ratio, while useful, can be incredibly misleading. A company can have a low PE ratio for many reasons. It might be in a cyclical industry at the peak of its earnings cycle. It might be facing a serious existential threat that the market understands, but that isn't yet fully reflected in the past year's earnings. Or, most relevant to our discussion, it might be a capital-intensive business that earns low returns on its capital. The market correctly assigns a low multiple to its earnings because it knows those earnings are of low quality. They require constant reinvestment and produce little free cash flow. Using a more sophisticated, less available metric like ROTA forces you to break free from this fixation. It compels you to move beyond the surface-level income statement, the E in PE, and connect it to the balance sheet, the tangible assets. It forces a deeper level of stock analysis, pushing you to ask not just how much did the company earn, but how much capital was required to generate those earnings. This is a much more insightful question. It shifts your mindset from that of a stock trader obsessed with price to that of a business owner obsessed with profitability and efficiency. It is, in essence, a cognitive tool for upgrading the quality of your investment decision-making. So let's build the blueprint. How do you, as a retail investor or an entrepreneur analyzing a business, actually calculate and interpret return on tangible assets? It's a three-step process that requires just a company's income statement and balance sheet. Step 1 is to find the earnings part of the equation. While you can use net income, a more effective number is pre-tax earnings, also known as earnings before tax, EBT. Even better is EBIT, or earnings before interest and taxes. The reason for using a pre-tax number is that tax rates can change for reasons that have nothing to do with the underlying business's profitability, and we want to measure the core operational efficiency of the business itself. You can find this number easily on the income statement. Step 2 is the denominator, calculating net tangible assets. This requires a bit more work, but it's where the real insight lies. You start on the balance sheet. Find total assets. From that, you need to subtract all of the intangible assets. The main ones to look for are goodwill and intangible assets. Goodwill is an accounting fiction that arises when one company acquires another for more than the value of its assets. It doesn't represent a real productive asset, so we want to exclude it. After subtracting the intangibles, you must then subtract the company's total liabilities. The formula is net tangible assets equals total assets, goodwill, and intangible assets, total liabilities. What you are left with is the net amount of real, physical stuff, factories, equipment, inventory that the company has used shareholder capital to purchase. Step 3 is the final calculation. You simply divide your number from Step 1, pre-tax earnings or EBIT, by your number from Step 2, net tangible assets. The resulting percentage is your return on tangible assets. A ROTA of 5% tells you the business generates 5 cents of pre-tax profit for every dollar of tangible capital invested. A ROTA of 50% tells you it generates 50 cents. This number is the measure of a company's economic engine. The final and most important part of the model is interpretation. A single number in isolation is useless. You must compare it. First, compare the company's current ROTA to its own history over the past 10 years. Is it stable and high? Is it improving? Or is it volatile and declining? Second, compare it to its direct competitors. A company with a ROTA of 20% might seem great until you realize its main competitor is earning 40%. Third, compare it to an absolute benchmark. While there's no magic number, many great investors look for businesses that can consistently earn returns on tangible assets of 25% or more. Ideally, you find businesses earning 50%, 100%, or even more. When you find a business with a long history of high and stable ROTA that is also higher than its competitors, you have found a potential investment champion. You have found a business with a deep competitive moat and a powerful financial engine, the essential ingredients for long-term wealth creation. To truly cement this concept, let's look at the antithesis, the kind of company an investor fixated on old, simplistic metrics might have bought, and the disastrous consequences of that decision. Let's travel back to the late 1970s and early 1980s and consider an investment in a titan of American industry, General Motors. To the average person at the time, GM was the epitome of a solid, blue-chip investment. It was one of the largest companies in the world. Its brand was a household name. Its factories were monuments of industrial might. And, during certain periods, its stock even looked statistically cheap on a PE basis. An investor following the herd would have seen this and felt a sense of security. They would have seen the tangible assets, the assembly lines, the real estate, the global infrastructure, as a bedrock of value. But a sharp-eyed investor applying a ROTA analysis would have seen a very different and much more frightening picture. They would have looked at GM's income statement and seen its earnings. Then they would have looked at its balance sheet and seen the absolutely colossal amount of tangible capital required to generate those earnings. The calculation would have revealed a chronically low return on tangible assets. Why? Because the auto industry, much like the airline and textile industries, is brutally capital-intensive. Building a car requires mind-bogglingly expensive factories and robotics. Developing a new model costs billions in research and development. Furthermore, GM was facing escalating competition from more efficient Japanese and German automakers. It had very little pricing power. It was locked in a constant, capital-draining war for market share. An investor who only looked at the PE ratio would be missing the most important part of the story. The E, earnings, was of exceptionally low quality. It was a mirage. The vast majority of any cash the company generated had to be immediately reinvested into retooling factories and designing new cars, just to keep from falling further behind. There was little to no free cash flow left for the owners of the business, the shareholders. Investing in GM in that era was like buying a ticket on a beautiful, majestic but slowly sinking ship. The sheer size of it gave the illusion of safety. but the underlying economics were rotting away. This is a classic value investing mistake that ensnares countless people, confusing a large, well-known, and statistically cheap company with a good business. The ROTA calculation is the tool that allows you to see the rot beneath the surface. It protects you from the glamour of size and focuses you on the reality of profitability. It is the fundamental difference between making an investment based on what a company buys versus what it does. GM2 was a giant, but it too did for job of generating cash for its owners. An asset-light business might be small, but its job, its very function, is to be a compounding machine for shareholder capital. Let's make this crystal clear with a direct financial comparison. This is the mathematics of wealth creation. Let's imagine two companies. Company A is Capital Intensive Corp. And Company B is Asset Light Limited. Both companies want to grow and have the opportunity to reinvest their profits back into their business. Capital Intensive Corp. has $1 billion in tangible assets and earns $50 million in pre-tax profit. Its return on tangible assets is a paltry 5%. Asset Light Limited is a much smaller business on the surface. It has only $50 million in tangible assets, but it also earns $50 million in pre-tax profit. Its return on tangible assets is an incredible 100%. Now let's assume both companies pay no dividends and reinvest all of their profits. In year one, Capital Intensive Corp. reinvests its $50 million. Since it earns 5% on its capital, that $50 million investment will generate an additional $2.5 million in profit next year. Its earnings will grow from $50 million to $52.5 million. Asset Light Limited also reinvests its $50 million, but since it can earn a 100% return on its capital, that $50 million investment will generate an additional $50 million in profit next year. Its earnings will double from $50 million to $100 million. Let's project this out. In just a few years, Asset Light Limited, which started at the same level of profitability, will be earning vastly more than Capital Intensive Corp. The value of the business, which is ultimately a function of its earning power, will have compounded at a rate that the capital-heavy business could never dream of achieving. This is the financial physics of compounding, and it is directly tied to the rate of return a business can earn on its invested capital. A business that earns a high return on capital is like a high-interest savings account. A business that earns a low return is like a low-interest checking account. Which one would you rather put your life savings into for 30 years? The choice is obvious. Yet millions of investors every day choose to put their capital into the corporate equivalent of the checking account because it looks bigger and safer. This is the core principle behind the entire Warren Buffett strategy. His goal is to find businesses that can reinvest large amounts of capital at very high rates of return for very long periods of time. High ROTA is the primary indicator of this ability. It is the mathematical signature of a superior business, the engine that drives portfolio growth, and the clearest path to achieving the kind of capital gains that can lead to genuine financial freedom. In the modern economy, the most powerful businesses, the true asset-light champions, have moved beyond just brands. They are built on invisible fortresses of technology, network effects, and intellectual property. The perfect modern anecdote to illustrate this is Warren Buffett's largest and most successful investment, Apple. When Buffett began buying Apple stock in 2016, many commentators were baffled. They saw Apple as a hardware company. They saw the iPhone, a physical product. They saw a company that had to manage complex global supply chains and invest in manufacturing. On the surface, it seemed to violate the principle of avoiding capital-intensive businesses. But Buffett, as always, was looking at the business on a deeper level. He saw what the market was missing. He understood that Apple was not a hardware company. It was the owner of the world's most valuable ecosystem. The true asset of Apple is not the factory where the iPhone is assembled. The true asset is the iOS operating system, the App Store, the iCloud, and the seamless integration between all its products. This ecosystem creates incredibly high switching costs. If you are an iPhone user, With all your photos in iCloud, your music in Apple Music, and your life organized around apps you purchased from the App Store, the thought of switching to an Android phone is daunting. It would be a massive inconvenience. You are, in effect, a willing captive in Apple's walled garden. This ecosystem also creates a powerful network effect. The more people who use iOS, the more incentive developers have to create apps for the App Store. The more apps there are, the more valuable the iPhone becomes to consumers. It's a self-reinforcing loop of value creation. Buffett saw this and realized that the physical iPhone was just the toll booth. It was the device that granted you access to this incredibly valuable intangible ecosystem. Apple could charge a premium price for that device because of the value of the ecosystem behind it. The business earns astronomical returns on the tangible capital it actually needs to employ. The research and development for iOS, while expensive, is a fixed cost that can be spread over hundreds of millions of users. The App Store is a digital distribution platform with near-zero marginal cost. This is the ultimate asset-light business model, cleverly disguised as a hardware manufacturer. Buffett's investment in Apple, now worth well over $100 billion, is the ultimate validation of the thesis he first developed with See's Candies, applied to the technological landscape of the 21st century. It is a masterclass in identifying an invisible fortress and understanding the financial power it wields. The failure to see the true nature of Apple's business is a classic example of a cognitive bias called functional fixedness. This is a mental block that limits a person to using an object only in the way it is traditionally used. A famous experiment gives a person a candle, a book of matches, and a box of thumbtacks, and asks them to attach the candle to a wall so that it doesn't drip on the floor. Most people try to tack the candle directly to the wall or melt some wax to stick it on, both of which fail. The solution is to empty the box of thumbtacks, tack the box to the wall, and place the candle inside it, using the box as a shelf. They were functionally fixed on the box's purpose, as merely a container for the tacks. In investing, functional fixedness causes us to categorize companies in rigid, simplistic ways. We see Apple, and because it sells a physical phone, we label it a, quote, hardware company. We become fixated on this label and analyze it as such, focusing on unit sales and manufacturing costs. This is a fatal error. Buffett was able to overcome this bias. He saw the iPhone not just as a phone but as a key to a kingdom. He saw the business not for its function, selling hardware, but for its economic structure, a high-return, high-switching cost ecosystem. This ability to think beyond simple categories is essential for identifying modern asset-light champions. Think about Visa or MasterCard. Are they credit card companies? No, that's functional fixedness. They are not banks. They don't lend money. They are payment networks. Their asset is the network itself, the trust and acceptance between millions of merchants and billions of cardholders worldwide. For a competitor to replicate this network would be almost impossible. They are toll booths on global commerce, an incredibly asset-light and profitable model. Think about Microsoft. Is it just a software company? No. It's the provider of the dominant operating system for business productivity, with massive switching costs. It's a cloud computing giant with its Azure platform, a business built on network effects and economies of scale. The retail investor who wants to succeed in the modern market must train themselves to break free of functional fixedness. You must learn to ask, what is the real business here? Where is the actual competitive advantage, the moat, coming from? Is it in the tangible assets I can see? Or is it in an intangible structure, like a network, a brand, a habit, or a piece of intellectual property? This shift in questioning is the key to unlocking a whole new universe of high-quality investment opportunities. To help with this, we can develop a mental model called the intangible moat identifier. This is a checklist for entrepreneurs and investors to systematically look for the sources of asset-light power in any business. Step 1 is to look for network effects. Does the product or service become more valuable to each user as more people use it. Facebook is the classic example. Your Facebook feed is worthless if you're the only one on it. Its value comes from the billions of other people connected to it. Telephone networks, credit card networks, and online marketplaces all benefit from this powerful force. A business with a strong network effect has a self-perpetuating marketing machine and a formidable barrier to entry. Step 2 is to identify high switching costs. Is it difficult, expensive, or just a major hassle for a customer to switch to a competitor? Think about your bank. Switching your checking account, with all its automatic payments and direct deposits, is a huge pain. That's a switching cost. Think about the software your company uses to manage its accounting. Migrating all that data and retraining all the employees on a new system would be a nightmare. That's a massive switching cost. Businesses with high switching costs can often retain customers for years, even if their prices are not the lowest, leading to stable, recurring revenues. Step 3 is to assess the power of brand and intellectual property. Does the brand command a premium price and customer loyalty, like Coca-Cola or Nike? Is the business protected by patents that prevent others from copying its product, like a pharmaceutical company with a blockbuster drug? A powerful brand is an intangible asset that lives in the consumer's mind, creating demand with minimal ongoing investment. A strong patent portfolio is a government-granted monopoly, another powerful asset-light source of profit. Step 4 is to look for regulatory moats. Does the company operate with a special license or in a highly regulated industry that makes it difficult for new entrants to compete? Think of a company like Moody's, the credit rating agency. To become a trusted rating agency requires immense regulatory approval and a decades-long track record of trust. It's an industry with a natural oligopoly. This checklist provides a framework for looking beyond the physical assets of a company and identifying the true sources of its economic strength. When you find a business that scores high on one or more of these factors, you have likely found an invisible fortress, a modern, asset-light champion that has the potential to compound wealth for its owners for many years to come. This is the essence of a sophisticated, modern Warren Buffett strategy. The antithesis of investing in these invisible fortresses is the growth-at-any-cost investor, a particularly dangerous mindset that became prevalent during the recent tech bubble. This is the investor who gets swept up in a compelling story and a charismatic founder, ignoring the underlying business economics entirely. The most spectacular and cautionary tale of this phenomenon is WeWork. On the surface, and in its marketing, WeWork presented itself as a technology company. It used buzzwords like community and the future of work. It was run by a visionary founder and was growing its revenue at an explosive rate. Investors, mesmerized by the growth story, poured billions of dollars into the company, valuing it at an eye-watering $47 billion at its peak. But if any of these investors had paused to apply the simple mental models we've discussed, they would have seen the terrifying reality, the brand power litmus test. A failure. WeWork had no real pricing power. It was competing in the commercial real estate market, and its prices were dictated by local supply and demand. The intangible moat identifier? Another failure. It had no network effects, no switching costs, and no proprietary intellectual property. It was just leasing office space long-term and subleasing it short-term. The capital expenditure treadmill test? A 5-alarm fire. Its business model was the definition of capital-intensive. It had to sign long-term leases on billions of dollars worth of real estate and then spend billions more on renovations and furnishings. Its balance sheet was a horror show of liabilities, and its cash flow statement showed a business burning through cash at a truly breathtaking rate. WeWork was not a tech company. It was a highly leveraged, capital-intensive real estate company with a terrible, asset-heavy business model, masquerading as a modern, asset-light champion. The investors who bought into the story without analyzing the business were functionally fixed on the tech label. They fell for the growth narrative and ignored the financial physics. The subsequent collapse of WeWork's valuation was not a surprise to anyone who understood the principles of asset-light investing. It was an inevitability. It serves as a stark reminder that revenue growth is meaningless if it comes at the cost of catastrophic cash burn and is built on a foundation of low-return tangible assets. The true path to wealth creation is not growth for growth's sake, but profitable growth, driven by a superior, asset-light business model. The financial proof of this superiority is written in plain sight on the financial statements of true asset-light champions. Take a company like Moody's, the credit rating agency, and a longtime Buffett favorite. If you look at Moody's balance sheet, the amount of property, plant, and equipment is minuscule compared to its market capitalization or its net income. Its business is built on an intangible asset, its reputation and its regulatory position as a trusted arbiter of creditworthiness. This business model requires almost no tangible capital to grow. To rate a new bond issuance, they don't need to build a new factory. They need to pay the salary of a team of analysts. As a result, the business generates a torrent of free cash flow. This is cash that, after all expenses and minimal reinvestment needs are met, belongs to the owners. What does Moody's do with this cash? It returns it to shareholders through a combination of steady dividends and massive stock buybacks. Over the past decade, Moody's has used its free cash flow to repurchase a huge percentage of its own shares. This action directly and powerfully increases the value of the remaining shares. Each share you own now represents a larger piece of the underlying business. This is a key component of a successful wealth management strategy. It's not just about picking the right stock, it's about owning businesses that are structured to systematically return cash to their owners. This is what drives long-term, market-beating capital gains. The contrast with a capital-intensive company couldn't be starker. The capital-intensive company's cash flow is perpetually consumed by the needs of the business itself, leaving little to nothing for the shareholders who are supposed to be the owners. One is a machine for creating shareholder wealth, the other is a machine for consuming it. This brings us to our final and most important pillar. Finding a great asset-light business is only step one. The ultimate level of mastery lies in understanding what happens to the geyser of cash that these businesses produce. This requires adopting what Buffett calls the capital allocation. This is the final key that connects a great business to a great investment. The foundational story for this concept dates back to 1967, with Buffett's acquisition of two small insurance companies in Omaha, National Indemnity Company and National Fire and Marine. On the surface, insurance seems complicated, but at its core, Buffett saw a business model that was not just asset-light, but asset-negative. It was a business that gave you capital instead of consuming it. Think about how insurance works. Customers pay you premiums today for a promise that you will pay for their losses in the future. In the time between when you receive the premium and when you have to pay out a claim, you get to hold and invest that money. This pool of money, which doesn't belong to you but that you get to use, is called float. Buffett realized that if an insurance company could accurately price its policies, meaning its premiums collected were roughly equal to the claims it eventually paid out, it would have a permanent, revolving pool of zero-cost capital to invest for its own benefit. It was like a bank that got its deposits for free. This was the ultimate asset-light business model. The business didn't require factories or equipment. Its primary asset was the trust of its policyholders, and its raw material was cash, which it got paid to hold. The acquisition of National Indemnity was the rocket fuel for Berkshire Hathaway. The float from the insurance operations provided the permanent, low-cost capital that Buffett could then deploy into buying other asset-light wonders, like See's Candies and the Washington Post. It was the master engine of his compounding machine. It taught him the ultimate lesson in capital allocation. The goal is not just to own businesses that produce cash, but to become a master at redeploying that cash into other high-return opportunities. This is the shift from being a passive stock picker to thinking like a CEO, like the owner of the entire enterprise. It's the mindset that truly unlocks the path to exponential wealth creation. To adopt this owner's mindset, you must overcome the psychological biases that keep the average retail investor trapped in a short-term oriented worldview. The two biggest culprits are myopic loss aversion and the desire for instant gratification. Myopic loss aversion is the tendency for people to feel the pain of a loss more acutely than the pleasure of an equivalent gain, and to evaluate their portfolios far too frequently. This leads to a neurotic obsession with daily stock price fluctuations. The stock goes down 2%, and it feels like a painful loss. The investor panics and sells. The stock goes up 2%, and they feel a fleeting pleasure, may be tempted to sell and lock in a quick gain. This mindset is completely antithetical to long-term wealth creation. The desire for instant gratification reinforces this. We are wired to prefer smaller, immediate rewards over larger, delayed rewards. We'd rather have one marshmallow now than 2 marshmallows in 15 minutes. In investing, this translates to chasing hot stocks, speculating on short-term news, and trying to time the market, all in search of a quick win. The owner's mindset is the antidote to these destructive impulses. An owner, like Buffett, does not view a stock as a blinking ticker on a screen. They view it as a fractional ownership stake in a real operating business. They are not concerned with what the stock price does today or tomorrow. They are concerned with the long-term cash-generating power of the underlying business. Will this business be earning more money 5, 10, and 20 years from now? Is the management team making intelligent decisions with the cash the business produces? These are the questions an owner asks. This requires a radical shift in perspective and a cultivation of patience. It means seeing a bear market not as a crisis, but as an opportunity to buy more of a wonderful business at a cheaper price. It means celebrating when a company you own uses its cash to buy back its undervalued stock, even if the stock price doesn't immediately react. It is the fundamental psychological leap required to move from gambling to investing, from renting stocks to owning businesses. It is the final ingredient necessary to harness the power of asset-light compounders for the purpose of achieving true and lasting financial freedom. To operationalize the owner's mindset, you need a mental model for evaluating the people at the helm of the companies you own. You need to judge the CEO not on their charisma or their stock-touting interviews, but on their skill as a capital allocator. We can call this the capital allocation scorecard. This is how you, as a shareholder, grade the performance of your management team. Step 1 is to analyze what the company does with its free cash flow, the money left over after all expenses and necessary reinvestments. Does it reinvest that cash back into the core business? If so, are those reinvestment opportunities likely to earn the same high rates of return that the business has historically enjoyed? For a company like See's Candies, there were limited opportunities to reinvest at high rates, which is why it became a cash cow rather than a growth engine. Step 2 is to evaluate their acquisition strategy. If they use cash to buy other companies, are they buying businesses that make strategic sense and are purchased at reasonable prices? Or are they engaging in diversification, buying unrelated, often mediocre businesses just to make the overall company bigger? An intelligent acquisition should strengthen the company's competitive moat or provide new avenues for high-return growth. Step 3 is to assess how they return cash to shareholders. Do they pay a steady, growing dividend? Do they buy back stock? Crucially, when do they buy back stock? A management team that buys back its shares aggressively when the stock price is clearly undervalued is acting in the best interests of its long-term shareholders. A team that buys back stock at record high prices might just be trying to prop up the stock price in the short term. Step 4 is the red flag. Do they squander the cash? Does it just pile up on the balance sheet earning a pittance in interest? Did they spend it on lavish new corporate headquarters, unnecessary corporate jets, or overpriced ego-driven acquisitions? This scorecard transforms you from a passive observer into an active overseer of your capital. It forces you to think like a partner in the business, holding management accountable for their most important job, the intelligent allocation of your money. This executive decision-making is often the ultimate differentiator between a good business and a great long-term investment. The enemy of the intelligent investor, the antithesis of the owner's mindset, is the empire-building CEO. This is an executive who is motivated by ego, not by per-share value. Their goal is to be on the cover of magazines, to preside over the largest company in their industry, to command a global behemoth. They are obsessed with size, often to the great detriment of their shareholders. The empire-building CEO loves making big, flashy acquisitions, often paying a huge premium for a transformative deal that garners headlines. The problem is, most of these large acquisitions fail to create value for the acquiring company's shareholders. The CEO gets a bigger empire to rule, but the owners are left with a more complex, less profitable business. This type of CEO will often take on huge amounts of debt to finance their expansionary ambitions, making the business more fragile and risky. They will authorize the construction of opulent, monument-like corporate headquarters, a tangible symbol of their power, but a complete waste of shareholder capital. They measure their success by the size of their revenues, their market share, or the number of their employees, rather than by the metric that truly matters, the long-term growth in intrinsic value per share. As an investor, you must learn to spot the warning signs of the empire-building CEO. Look for management teams that talk incessantly about being the biggest, rather than the most profitable. Be wary of companies that are constantly engaging in large, complex mergers. Read the annual reports. Does the CEO speak in clear, honest language about the business's performance, admitting mistakes? Or is the report filled with corporate jargon and self-congratulatory nonsense? Avoiding the companies run by empire builders is just as important as finding the companies run by skilled capital allocators. It is a critical part of protecting your capital and ensuring that the wonderful businesses you invest in are managed for your benefit, not for the ego of the person in the corner office. Finally, let's connect all of this to the long-term financial outcome. Let's quantify the staggering power of this single principle when it is allowed to work its magic over time. This is the direct financial connection that underpins the entire philosophy. Consider a business that consistently earns a 25% return on its tangible capital and is able to reinvest all of its earnings back into the business at that same high rate. If you invest $10,000 into this business and it continues this pattern, your initial investment will compound at 25% per year. After 10 years, your $10,000 would be worth over $93,000. After 20 years, it would be worth over $867,000. After 30 years, it would be worth over $8 million. This is the explosive and non-linear power of high-return compounding. Now, contrast this with a typical capital-intensive business, one that earns a consistent but mediocre 6% return on its tangible capital. You invest the same $10,000. After 10 years, you would have about $17,900. After 20 years, you'd have about $32,000. After 30 years, you would have just under $58,000. The difference is not just a few percentage points. It is the difference between creating life-changing wealth and merely keeping pace with inflation. The $8 million versus the $58,000. Both started with the same $10,000. The only difference was the quality of the business engine the capital was put into. This is not a theoretical exercise. This is the story of what happened to the early investors in companies like Berkshire Hathaway, Microsoft, or Moody's. They bought into businesses with extraordinarily high returns on tangible capital, run by skilled capital allocators, and they had the patience to let the magic of compounding do its work over decades. This is the ultimate goal of the Warren Buffett strategy. It is not about finding stocks that will go up next week or next month. It is about identifying these superior economic engines, buying them at a fair price, and holding them for the long term, allowing the physics of financial gravity to work in your favor. Mastering this one concept, the pursuit of asset-light businesses with high returns on tangible capital, is the single most powerful tool you can add to your arsenal as an investor. It is the fundamental blueprint for building a portfolio designed not just for growth but for the creation of lasting, generational wealth. You have just spent this time fundamentally rewiring the way your brain analyzes a business. You have moved beyond the superficial metrics that trap 99% of investors and have acquired a powerful mental tool used by the greatest capital allocator in history. The concept of return on tangible assets is no longer an abstract idea. It is a lens. It is a framework you can now apply to any company you look at, allowing you to instantly cut through the noise and assess the quality of its economic engine. You now understand why a small, profitable software company can be a far better investment than a massive industrial giant. You can spot the capital-intensive traps from a mile away, and you know how to hunt for the invisible fortresses that create true, lasting wealth. You have taken a massive step away from being a mere retail investor and toward becoming a genuine business analyst. But what you've just mastered, as powerful as it is a single, crucial piece of a much larger interconnected system. Warren Buffett's mind does not operate with just one tool. It is a latticework of mental models that support and reinforce each other. He combines this analysis of business quality with the discipline of only investing within his circle of competence. He fuses it with the ironclad rule of demanding a margin of safety before ever committing capital. Understanding return on tangible assets tells you what to buy, but knowing how to integrate that with the principles that tell you when to buy and at asterisk what price, that is the next level. That is how you assemble the complete mental arsenal of a world-class investor. The machine only works when all the gears are turning together. The video that is now appearing on your screen is not a random suggestion, it is the next piece of the map. It is the link that connects the principle you've just mastered to the next component in that latticework of thought. Think of what you learned today as learning how to build a powerful engine. The video on your screen is the blueprint for the chassis and the steering system. One without the other is incomplete. The journey to financial freedom, to becoming a truly sophisticated investor, is a process of assembling this complete system, piece by piece. The choice to click is not just about watching another video. It is a decision about your identity. Are you content to remain on the surface with a single tool? Or are you committed to continuing your ascent, to building the full intellectual framework required to truly master your financial destiny? The next piece of the puzzle is right there. The choice is yours. Complete the machine.